Hello. In this video, we are going to talk a little bit about market risk and diversification. In the prior section, we sort of introduced different categories of risks that a company might be exposed to or an investor might be exposed to, and now we're going to dig into market risk specifically. So, here's the deal. First of all, let's just assume for a second, make this simple. We're talking about the investors in a company, and that an investor on one side might be a buyer of an investment and somebody else might be selling it. And that buyers, and this is just true in general, want to maximize their return or their profit on their investment, and they do this by seeking to purchase at the lowest price possible. They can't control what happens afterwards, but they figure if they purchase at the lowest price possible, then they put themselves in the best position to have the most profit going forward. Sellers, on the other hand, desire to maximize their return on the investment as well, but they do this by seeking to sell at the highest price possible. They already know what has happened, so they're not in the same situation, but they would like to argue basically and have some rationale for why they should be able to sell at a higher price. Between the two of them, they are going to have to settle on a price so that a transaction happens. And the price that they settle on, we will assume, absent some other something going on, that it's something that both sides believe is fair. And so there's no coercion or anything. They're just, settle on a price that they both are willing to accept. Otherwise, I guess a transaction wouldn't happen. The theory would suggest that that price reflects or implies some fair return on investment for the buyer. Probably for the seller as well, but at a minimum, the buyer, the new investor, should feel happy with the return, or maybe not happy, but not so upset that they just walk away from the deal. But they are accepting of the return that they think they would get from the investment. Further, that return, according to theory, on the investment that the buyer is willing to accept should reflect the risk that they are assumed from taking on the investment. And that would be any risk that's in there. So theory would say that part of what goes into the return that a buyer wants on something is related to how risky they perceive the investment to be. So if you can kind of envision this, I'm trying to give you a little bit more, less theoretical and more practical version of this. Imagine you've got a buyer and you've got a seller. So the buyer is basically saying, I think that this is a very risky investment, and based on that, I am looking for a fair return of 12.5%. If I just use the simple sort of perpetuity models that we've used in the past, let's just say that earnings per share are $2.50, and they both expect that those are just going to continue on in the future at $2.50. So $2.50 divided by 12.5% is equal to $20. And so the buyer is basically saying, I shouldn't pay more than $20 for this. The seller, on the other hand, basically feels like it's not that risky. 12.5% is a ridiculous return for something this risky. Probably 10% makes more sense. And so since we both agree on earnings per share at a 10% discount rate, I should be able to sell this to you at $25 and you'll be happy with that. And so that's the tension between the two of them in a nutshell. Now, in this case, we're assuming that they both agree on the future, earnings per share and growth and all that sort of stuff, which can be another fly in the ointment. But today we're just assuming that they agree on all of that, and all they're really haggling over is the fair return. So, embedded in the risks, one of the categories we talked about is market risk. So that's the potential risk that the buyer has that they may lose money due to changes in market price. So if they pay too high of a price, then they are more exposed to the possibility that at some point when they get ready to sell it, that the price will be lower than what they paid for it and they'll actually lose money on the investment. However, financial theory also says that due to diversification, the incremental increase in risk associated with holding an investment as part of a broader portfolio of investments is less than the risk of the investment on a standalone basis. Man, that's a mouthful, and we'll cover that. We'll give you some examples of that in just a minute. But the bottom line is that because of correlation, there is the possibility that the potential loss of value that the participant, the buyer, let's just say, might experience from this particular stock may coincide on sort of a regular basis with a gain in value in other stocks that the investor holds or could hold. And therefore, the overall potential for loss to the investor is not as great as it would be just looking at this one element. And so at the end of the day, the question is, if you can diversify away this risk, should the investor still be able to be, the buyer in this case, should they be allowed to demand a return that's based on the standalone risk of the investment, or must they consider the fact that that this risk could be reduced through diversification? And so again, kind of thinking about how this works, we've got the same situation with the buyer and the seller, but we now sort of understand why they are not necessarily agreeing on the fair return. The buyer is looking just at the riskiness of the investment on a standalone basis and saying that that riskiness justifies a return of 12.5%. The seller is looking at this on a diversified basis and basically saying, after you take into consideration the way that it interacts with other stocks in the market, quite frankly, it reduces the overall risk of this investment, adding this investment to the portfolio to the level that 10% is fair. And so that's the debate, which one of these is right. And again, at some point, they're either going to meet in the middle, or it's going to go to one side or the other. A price is going to be determined, okay? And so the challenge for the theory is this conversation's going on, and we're trying to explain what the disagreement, where the disagreement starts, and what the best way to resolve it is. And so that's really what, again, as it was before, the idea behind the theory is it's trying to explain, you remember before we had theories that were trying to explain price. Now we're trying to explain the return that goes into figuring the price as a way of then better explaining the price. So when we talk about this notion of diversification, let me give you kind of an example of this. So first thing, let's look at it at Yahoo stock. Here is a plot over time of the daily return on Yahoo stock. So I just took its price on a day divided by its price at the close of the prior day minus 1. And so if you see 8% here, that means on that day it went up by 8% of its value. So maybe, I don't know the dollar amounts, but let's say it went from $100 to $108. If you see a negative 4% or 5% down here, then maybe it went down by 5%. So, again, you can figure that out yourself. But, it's 95% of whatever it was. So if it was 100, it went down to $95. And that's plotted over time. If we take those same values, those returns, and we put them in a probability distribution, we can see that most of the returns, most days, the returns are pretty close to zero. In fact, the average return is just barely over 0.08%. So that's not 8%, that's 8/100ths of 1%, very low over this period. Standard deviation is about 1.91%, and standard deviation, as you know, describes how wide the distribution is. And the worst loss that we saw over the period in any single day was about 6.2% loss. So that's the risk of holding Yahoo stock on its own, not included in any portfolio. Now let's do the same thing for Apple stock over the same period. Again, you got kind of the plot. There was some bad 6% down days. There was some 6% up. The average return is it's actually negative 2/100%, effectively zero again. Standard deviation 1.54, the other one was 1.91, so it's a little less risky in that sense, but it has a little bit larger max loss. So now let's see what happens when we put them together. So now we've combined them into a portfolio, and so bad days for one get offset by good days for the other. Notice how, I'm going to go back and let you look at this for a second. See, the axes are the same, so see how wide this is spread out and how wide this is. And again, I keep the axes the same for all of this. And this is fairly wide, maybe not as wide, but still pretty wide. And you know, see how wide this is. Now you put the two together, quite a bit narrower there, quite a bit narrower there, and the max loss goes down to 5.2%. So the max loss on one of them was 6.2, the other was 6.5. Together, they only have a max loss of 5.2%. This is what happens because of diversification. Standard deviation goes down, the worst possible outcomes tend to go down, and it really is just the process of over time, that on any given day when one of them does well, the other one might do poorly, or vice versa, and they sort of offset each other. So then what happens if you just kept adding to this? Well, I took about 9 stocks and added those in here together. And so instead of a portfolio of just Yahoo and Apple, it has 7 other stocks in it. Mean doesn't change much. Standard deviation goes down a lot. Again, just looking at what happens here, you see the variability goes down, shows up here. Max loss is 4.4% instead of 5.2%. Standard deviation is 1.26% instead of 1.43%. So just by adding, going from 2 stocks to 9 stocks, you've dropped the overall risk quite a bit. Now, imagine that you held the entire S&P 500, and so you held stocks in each of the stocks of the companies in the S&P 500. Things go down a lot. Again, these are all on the same scale. The axes are all on the same scale. So you can see here's what happens with 9 stocks. Here's what happens when you have the whole S&P 500. Your standard deviation goes from 1.26 down to 0.88. That's reflected in that this is skinnier. This is also not jumping around nearly as wide. The worst loss is 3.6%, down from 4.4%. And if you remember, we were at like 6.5% with the one stock. And so you've cut this almost in half. And so when you add it to that portfolio, you're not necessarily adding risk, or if you are, maybe just a little bit, you may actually be reducing risk by adding it. And so that is the effect of diversification. And it really comes down to this. The uncertainty and risk of loss in a portfolio gets smaller as more investments are added to the portfolio, assuming that the investments are not perfectly positively correlated. If you put 2 investments in a portfolio that are perfectly positively correlated, that basically means that when one goes up, the other goes up in a similar fashion. It may not be 1 for 1, but they tend to react, and they react. When one goes up, the other always goes up. When one goes down, the other always goes down. And so you can see you don't get the benefit of that offset where one sometimes goes up, the other goes down. As long as they're not perfectly positively correlated, it can be demonstrated mathematically that the variance in standard deviation of the combination of the two will always be less than just taking the average of the variances of the two. And so there's a mathematical proof for that. I'm not going to ask you guys to do that or know that at this point, but suffice it to say that there is. Now, this is true, it is mathematically true for a large number of investments, in fact, all of them. But the reality is that the diversification starts to get less and less. The benefits of adding any new investment get less and less as the portfolio gets bigger. And so, while you may get a real big bang for the buck if I only have 8 stocks in my portfolio and I add a ninth, I probably don't get as much bang for the buck in terms of reduced risk if I have the 500 S&P stocks and I add one more and make it 501. So it does reduce the risk of the portfolio some, but the key is that it does not markedly, because you're reducing it some, you can't actually think in terms of that by buying this additional stock and putting it in my portfolio that I am assuming all the extra risk of this stock. I'm not. It has some offset. So at the limit, you could hold all the possible investments that are out there, in which case there would be no more to add. You would have the most diversified portfolio you could possibly have because there's nothing else you could add to it. This is what's called the market portfolio. And so theoretically, if you had that, you would now be able to say, this is what the risk, this is the most diversified risk I can have, and therefore this is the lowest amount of risk for which I deserve some compensation. So what market risk theory says is that investors should not be compensated for risks they can otherwise diversify away. So think about this for a second. The market portfolio is the only fully diversified portfolio. The risk in the market portfolio must be due to factors that cannot be diversified away, because if they could, they would have gone away. We call those factors systematic risk. And so investor compensation for risk, so what we would call the risk premium, or the market risk premium in this case, should be determined based on the exposure to systematic risk. So when I add that stock to my portfolio, if it makes the overall risk go up, I should get rewarded for the degree to which it adds systematic risks that are consistent with the riskiness of the market portfolio. And therefore, I shouldn't compensate for the total risk, only for this notion of systematic risk. I got to tell you, first time I heard this, I'm like, I get the concept of systematic risk, but I really do not have a clue what you mean in terms of how you would get to that. So, I want to talk about a couple of different approaches that have been taken to this. One is called the capital asset pricing model. That approach very simply comes down to this. The market portfolio is the most diversified portfolio. It reflects systematic risk and systematic risk only, because everything else, all the what we would say are unsystematic or idiosyncratic risks. Think of it as the risks that are really just the risks that companies have individually, have all been diversified away. And the only thing that's left are uncertainties that are due to sort of systemic things that happen, business cycles, broader government policies, inflation, things like that. And so basically that's what causes the value of that portfolio to move around is the sort of undiversified impact, the diversified impact of all that news on all possible investments. And so all of those systematic risks must be reflected in the market portfolio, because that's the notion is that the prices that move in the market portfolio based on these risks, and that only systematic risk is reflected in the portfolio because the rest of it is diversified away. Therefore, what the capital asset pricing model says is that systematic risk is the risk of the market portfolio, or said differently, that the risk of the market portfolio is systematic risk. They're one and the same. And so if you wanted to say, this whole concept of systematic risk, where do I get a measure of it? They would say, just track the variability in the prices or returns of the market portfolio, that is the impact of systematic risk. So then they would go one step further to say that the risk premium for any investment could be determined by the degree to which a change in the value of the investment can be explained by a change in the value of the market portfolio. So since the market portfolio only moves when due to systematic risk, then if your particular investment's value moves it in a way that's similar to the way that the market portfolio moved, we could infer that that's probably because of systematic risk. If, on the other hand, your investment value moves and the market portfolio really hasn't changed value, then your movement probably isn't because of systematic risk. And so that's just sort of the logic of it. And so then what we would say is that if you have changes in the value of your investment that can't be explained by changes in the value of the market portfolio, you should ignore those elements of risk. You are not entitled to return on them. And because this model basically says the market portfolio is the one factor you have to look at, it's called a one-factor model. Here's sort of the formulation of it. Says that the return on your investment, required return on your investment, is equal to the required return on a risk-free asset plus the beta of your investment, which is saying how sensitive is your investment to systematic risk, times the return on the market portfolio minus the risk-free rate, so the risk premium of the market portfolio. And so kind of using a numerical, well, we'll go ahead and do this. First, let's talk about the beta on that, and then we'll give you a numerical example. This whole concept, this beta, a lot of times throws people off. Here's what's going on that. So remember, we had Yahoo and we had the S&P, and those were the two charts. If we were to take those and reorganize those into what's called a scatter plot, in this case, S&P is on the bottom axis and Yahoo is on the vertical axis. So horizontal axis S&P, vertical axis Yahoo. And we just took each of the points and plotted it in that grid. And so, for example, if you look here, you'll see Yahoo made 6% on a day. I forget what day that is. It's probably, I think it's like December 5th or something like that. So Yahoo made 6% that day, but the S&P lost about a percent. And so sure enough, Yahoo's at 6%, S&P's at minus 1%. So that's where we put that dot. And we create a dot for each combination on a particular day. So each of these dots is an intersection between what the price of Yahoo or the return on Yahoo was on that day, change in price, I guess percentage change in price, and what the percentage change in price of the S&P 500 was on that day. So we've plotted all those out, and we can see there's kind of a relationship. It looks like that when the returns on Yahoo are higher, the returns on the S&P are higher, and when the returns on Yahoo are lower, the returns on the S&P are lower in general. And so there seems to be some sort of relationship. If we were to do a simple regression on that, which is what I did, and this is the equation of it, it would solve for the line that best describes the tilt, if you will, of this relationship between Yahoo returns and S&P returns. And when we did that, it came out with an intercept of basically 0. So there's really no risk-free rate here. Plus about 1.3 times the S&P. And the way to think of that is that for every 1% change in the S&P, so let's say the S&P return goes up by 1% in a day, Yahoo tends to go up by 1.3%. And when the S&P goes down by 1%, Yahoo tends to go down by about 1.3%. So more volatile than the S&P, which we wouldn't be surprised with because we can see the difference between these plots anyway. So putting that into beta, now I assumed a risk-free rate of 1 here, even though the regression's saying about 0. But let's just say that we have a risk-free rate of 1. Let's say that the return on the market's 6%. We didn't see that either, but let's just say it. Think of it as the expected return, not the actual return. Beta of 1.3, we would simply plug them into the capital asset pricing model, right, that we put out there before, the same formulas from the other side. So it'd be 1% plus 1.3 times 6% minus 1%, so times the risk premium. So the risk premium's 5%, 1.3 times that becomes 6.5%. Add 1 to it, becomes 7.5%. And voila, what you've determined is Yahoo has the fair return on Yahoo investments should be 7.5%. Okay, so that's how the CAPM works. If you believe all of that, here's the challenges. First, the market portfolio is the portfolio of every possible investment in every possible asset class. So we're not just talking every possible stock, even though, that's out there, right? And we're not just talking about traded stocks. It could be stocks on private companies that you can't get through the stock market. But we're also talking about bonds. We're talking about real estate. We're talking about art. The inner workings, the inner theoretical rationale behind the market, the capital asset pricing model, is that the reason that the market portfolio is weighted the way it is and has the returns that it has is because it reflects all of the choices that an investor has for what they could do with their money, and it makes the assumption that they are going to allocate their money efficiently, and so they're only going to put their money into things where the return is justified by the risk, or I guess the risk is justified by the return, I would say, and they're not gonna invest as heavily, or they're not gonna favor things that don't give enough return for the risk, and then eventually that's going to force this relationship. While that sounds good in theory, we don't even know what the market portfolio is. A lot of times we will approximate it by, say, a large set of stock, the Dow or the S&P, or the Russell or whatever. But again, even there, we're shortchanging the theory because we don't have anything other than the stock asset class in there. So conceptually, we just have this problem that says that go figure out both the dollar values and the weightings and the changes in returns on the quote-unquote market portfolio. And then practically, when we sit down to do that regression, first of all, we have no idea how long of a time series for how many data points we're supposed to do that regression. We don't know what we're supposed to put in as the risk-free rate to calculate the market risk premium part of it, simply because we don't know, right? And so sometimes people will just let the model solve for the implied risk-free rate. But technically that doesn't fit the theory. You shouldn't be getting a different risk-free rate for every investment. It should be the same at the same time. But even if it was it the 1 month risk-free rate, the 1 year, the 5 year, the 10 year? We don't know. And then similarly, everything that you're running at that point is backward looking. It doesn't reflect what the investors wanted to earn over the past period. It reflects what they did earn. And so it's not necessarily a measure of what they wanted to earn, or even what they think might happen in the future. It's just a measure of what happened in the past. And so, again, what we really have is the case with a lot of other theories. We lack the data that the model requires in order to be perfect, to really apply it. We have something that we could stick in there and it gives a result, but there's no particular reason to believe that what we're sticking in there and the result it gets is any good. I think somebody's used the term garbage in, garbage out. This is certainly that. So then there's this second approach. It's called the arbitrage pricing theory. It takes a slightly different view. It doesn't require you to go out and find the market portfolio. Rather, what it does is it says systematic risk is reflected in systematic variables. And systematic variables are variables that you would expect that would have a broad impact on all of the economic activity in the country, including your firm and others. And so that might be inflation, economic growth, consumer confidence. I'm sure there's all sorts of examples of variables that you could do there. And so it does not require that we specify in advance what those are or what the weightings on those are or anything else. And so it's really intended to if you will, open up the CAPM and allow you to have multiple factors in it. And that's why it's called a multi-factor model. It assumes that the risk premium for an investment can be determined by the same sort of regression we used before, but basically that it's how sensitive are the returns on the investment to changes in these systematic variables over time. And again, it does predict that if there is a change in the value of your investment that is not explainable by these systematic variables, then you can't count that as part of the risk that you should be compensated for. So there's a consistency here around this idea of systematic risk and only being compensated for systematic risk, where the APT differs from the CAPM is really that the APT doesn't try to force this issue that there's some notion of a market portfolio and that's the only variable you need to know. So slightly more relaxed, I think, approach is what we would usually say. Here's kind of an example of that. Again, it's it's very vague because you don't know what anything is in here. So you do have the required return on your investment. You do have risk-free. Then you've got these factors and the betas on these factors. So you have a factor 1, 2, or 3, and that factor could be whatever systematic variable or factor you want to think of. So F1 could be inflation, F2, consumer confidence, GDP, whatever you want out there. And then the beta is how does that factor, changes in that factor, relate to your specific investment? And so the beta factor 1 may be different for your investment than it is for other investments. And so to give you kind of an example of that, let's just say that we picked 2 factors, consumer confidence index and change in gross domestic product. That's factor 1 and factor 2. And so factor 1 times beta 1, let's just say that it's solved for a beta 1 of minus 1%. And a minus beta would say that when consumer confidence improves, that the required return goes down. I'm not saying that that's what the research shows, but you could imagine that consumer confidence going up makes people less worried about the future, and therefore they perceive a lower risk of bad things happening and a lower risk of loss. And so that might make sense. Improvements in GDP. This time I've assumed it raises the required return for no particular reason, but by a factor of, I have 4 up here and 5.5 down there. Let's just use the 5.5. I don't know why I did that. So if we plug that in, we got 1% plus 1%, which is minus 1%, which is this beta, times 111%. Okay, plus 5.5, which is not a percent, it's just 5.5 times the 1.9%. So if I were to solve all that out, what I basically wind up with is 7.59%. And I have no idea whether I did that right, but we're just going to hope that I did. I actually think I did this on the basis of 4 and left the 5.5 in here. So you guys do it on the basis of the 4, and I think the math will work out. So, nice theory, got the math. Conceptually, problem with this one, so the CAPM, the problem was it was very specific about what the one factor is, but you can't measure it. Problem with this one is that it doesn't even tell you what the factors are. So you and I could disagree as investors on which factors to consider If we ran those regressions with different factors or different measures of those factors, we might get different results. And so neither of those really explain how some buyer and seller would actually mentally use this process to come to some consensus around a required rate of return. So, at the end of the day, while they're probably the best theories that we have right now, and there is some consistency of their use in the market, the bottom line is that as an explanation of what actually goes on in people's heads when they argue about when to buy or sell and at what prices, not sure that these do a very good job of explaining that. Not really behavioral models in this case, maybe more economic. And then, of course, practically got the same issues. We don't know anything about the maturity of the risk-free rate. We don't know what required return to use. We don't know. Again, all we'll have is data about what happened in the past. We don't know if investors are still thinking that the same relationships hold going into the future. We don't know if what happened in the past was what they expected or it was very unexpected. So all the same challenges. So where does that leave us? Well, here's the deal. It does seem clear. Most investments come with some market risk. We get that. Seems clear that investors have the ability to reduce market risk by combining investments into a portfolio. So this whole diversification thing is not a theory, it's a fact. We can observe it. At the limit, the only market risks that cannot be diversified away are what are called systematic risks. That's almost a definition. It's a systematic risk because it can't be diversified away simply through combining investments. So, and the return that investors should reasonably expect to earn on their investments due to market risk should only consider systematic risk. Generally speaking, both of the theories agree on that. Again, those are theories. All these others we can observe. This is really the only theoretical thing that we find here. It's also clear that there's no single universally agreed definition of what factors count as systematic risk, and there are no available sources of information on the variation in the value of all the systematic risk factors, and how those should be viewed in terms of determining the required return on a market risk for an investment. And so we lack all of those things that would be required for us to come to some consensus among ourselves on required return. So given this, it makes economic sense that buyers and sellers of investments consider systematic market risk in their negotiations. But it would be difficult in practice for them to agree on measures of systematic risk around which to base their negotiations. And so, that's just, I know that's not particularly rewarding, but that's kind of where we are. You can think about it conceptually, you can consider it conceptually, you can run your own analyses, and yet you guys may still disagree. And so if we went back to our picture before of the buyer and seller negotiating, it could be that they are both talking about only systematic risk, and they could still disagree on the risk premium by that amount. So the good news there is they would at least be still talking of only, they would be on the same page about that they only want to get compensated for systematic risk, but we won't have solved the problem of really closing in on a fair value for them. So I know this is somewhat unsatisfying for you, but it's sort of the lay of the land, and I want to make sure you guys understood that. Thanks.